Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We're coming to you live from the CNBC-TV18 Motilal Oswal studios. Started for a fresh new week, and hopefully, as we've sort of started the last couple of Mondays, maybe we are in the last stages of what has been an absolutely brutal market for the last couple of months actually now. So that's the hope. Of course, we'll find out what happened. It's a full deck in terms of events, etc., which are lined up over the next 5 trading sessions. I'm Prashant. With me, my colleagues Nigel and Surbhi is back with us. Surbhi, hi. Morning. Nigel, morning.
Hi, morning. Welcome back, Surbhi.
Thank you.
You're looking...
I've got the green.
Yeah.
Because you guys had too much of red, I think, in the 3 days that I was away. But intense sell-off. And like you're saying, even I'm getting that feeling, Prashant, that maybe looking at the sheer capitulation and the fact that it's market-wide, nothing has been spared. Yeah. When it comes to that brutal of, we're in almost an Armageddon-like a situation. So perhaps now it feels like this could be nearing the end, hopefully.
Sentiment has taken a very hard knock. Normally you come back from the weekend and everyone's giving you a lot of buy ideas. Yeah, people are asking, what's the bounce to get out? So that's the kind of mood. But sometimes these provide the best opportunities, right, in terms for a longer-term investor.
For long-term wealth creation.
Indeed.
Absolutely.
All right. Well, I think we'll just take it from the start and assess the damage what we've seen from the highs, and that'll put things into context. So you've got the Nifty, which is down about 16% from the highs that we've seen. The Nifty Bank has fallen about 11%. Mid-cap index is down 21%, and the small-cap index has lost about 25% of its value. So that's basically the picture out there. Now, sectorally speaking, we've got real estate, which is the biggest damage, 31%, PSU banks. I mean, actually, the next 3, PSU, CPSU, oil and gas, the common thread is PSUs because all these indices have a lot of government companies and they're all on an average down about 29% or so. The one space which till about 2 weeks back was relatively insulated was the IT services index. The IT services index was down about 8% from its highs, but last week it changed. That is, look at the 7-day change, that's about 10% lower. So last, 6, 7, 8 trading sessions, I mean, really the bottom fell off. And the IT index now also is down about 18%, lesser than many other sectoral indices. But that's an important constituent, sort of IT and banks, right? And also sort of institutionally owned in a big way. So that's the picture as we sort of begin this new session. That's the backdrop. Now, what did we see on Friday as far as US session is concerned? Equities in the US were looking a little shaky. The second half, the last 10 days of February, basically, were looking a little shaky. And it looked like maybe, perhaps a short-term top. Some are saying a long-term top is in for it, especially the tech stocks, NASDAQ, the Magnificent 7 companies, etc. But on Friday, and we'll have to track this is just 1-day bounce, but equities did bounce back. NASDAQ was up about 1.6%. To put this in context, even after, all those doubts and the correction and the pullback, etc., we've seen in the US over the last 1 week, 6, 7, 8 days, the S&P is still about 3.5% from its all-time highs. So we're still, in terms of actual price damage, it feels a lot worse. In terms of actual price damage in the US, it's not been very much. The Wix fell about 7%. That actually had risen to about almost 22 during last week when the market in the US was looking sort of fearful. The 10-year lost about 5 basis points. We're at about 4.21%. And lots of recent data points in the US, high-frequency data points, have all been pointing to a little bit of slowdown. I'm not going to go into each one of them, but just to summarize, look at the Atlanta Fed's GDP Now model, which basically takes in all these high-frequency data points. That on Friday is now estimating the first quarter GDP in the US at minus 1.5%. That number 2 weeks ago was plus 2.3%. So that's the rate of deterioration that we've seen as far as high-frequency numbers is concerned. So keep that in mind. And that's the reason why we had markets also starting to fret a little bit about whether valuations are too high, etc., because underlying growth looked like it was starting to slip. Tariff threats, etc., whatever. But that's essentially the fact that we've seen play out in the last 2 weeks. Dollar index about 107.61. And because US growth, high frequency numbers, etc., are slipping a little bit, you could say that towards the end of last year, what is the one word used to describe US markets? US exceptionalism. So maybe US exceptionalism at the margin is moderating a little bit, and that perhaps will push the dollar lower. But what is keeping the dollar higher and it's pushing the other way is the threat of tariffs. And that's where I come in terms of what is going into effect from tomorrow. So 25% tariffs will go into effect in Canada and Mexico from tomorrow, a 10% additional tariff on China. This is, of course, barring a change of heart from Donald Trump, the US president. And it's possible. Last-minute changes, and he says, well, I'm going to delay this till April. I'm going to look at all the tariff-related stuff together on the 2nd of April. We don't know. But as of now, as we start this morning, that's the timeline, really. The other thing, of course, was, and we'll play the visuals out, disastrous exchange on Friday between Trump, the Vice President of the US, J.D. Vance, and the Ukrainian President Zelensky. No minerals deal, but that was the least of the problems. It was an on-camera argument which kind of went on, and I urge you to go and watch it if you've not already. And of course, does that mean that the probability of a peace deal which was looking imminent between Russia and Ukraine has gone down? We'll talk about this. We'll discuss this. So that's the backdrop as we start this morning. Just to sort of tie in the levels here, Nifty should find support. I mean, I think around the 22,000 odd levels. We are there, 22,130. Multiple, if we break 22,000, multiple lows were formed between 21,800 and 21,900 in mid of 2024. So roughly, broadly, the range you're looking at on the downside is 21,800 to about 22,000. That's the support zone. Resistance is the 40 hourly exponential, which is 22,531. Again, not very far away at all, 1.5–2% away. Bank Nifty resistance stands at 48,710. Again, these are very, very close by. And supports come in at 48,078 and 47,844. I mean, the market's got to stop falling, and then we'll sort of start to talk about repair, recovery, etc., because the falls have been very sharp on a day-on-day basis as well. So about a 70-odd point higher start is what the GIFT Nifty is implying. Surabhi.
Prashant, I completely agree with you. I went back and watched the entire 40-minute feed. It's gold. You have to watch it. That's a short point in our reporting history, and most of us have reported on geopolitical meetings and big leadership events. Nothing like this ever seen before. Anyway, let's come back to some additional cues. So the good news is that at least on Friday, the fall on Wall Street also paused, which is why the overall cut for the Nasdaq for the week as a whole is now just about 3.8%. Some additional data points. The consumer spending number that came out of the US, that's telling you where the issues and the worries are, whether the economy is indeed slowing down. That spending number, showed a decline of 0.2%. This is for the month of January. The PCE numbers have been fine, about 2.5%, of an increase in Jan, which was in line with what the broad expectations were. Now, talking about this big spat between Trump, Vance, and Zelensky, this actually led to a move in markets. It was not just entertaining television, it was real market factors, because that caused the intraday dip. Thankfully, it got bought in by the equity market, but even in currencies, the euro fell almost 0.3% as that exchange was going around. And then there's a recovery. This morning, the euro is actually stronger versus the dollar by almost 0.4% as it's recouping some of those losses. Quickly coming to Asian markets, again, it's a story of recovery playing out here as well, and the bulls will hope that they can build on this. Most markets are up anywhere between 0.5% to 1.5%. The Hong Kong and the Chinese markets are doing actually pretty well this morning. They are the ones that are gaining the most. Lots of PMI numbers, they're up on your screen right now. Taiwan's a bit of an outlier, but otherwise the region is largely positive. Lots of PMI numbers out of manufacturing PMI numbers out of Asia this morning. So in Japan, the PMI numbers looking steady, 50.4 for the month of February versus 50.6 in January. But the real outlier is the Caixin PMI number out of China. Big positive, blow past expectations is what China has done. We've got a number of about 50.8, and that's also a 3-month high for the Caixin, Chinese manufacturing PMI. So that's good news coming in terms of the economic indicators from these two regions. On trade, there were some additional comments. U.S. Commerce Secretary Howard Lutnick was speaking to Fox News on Sunday, and he kind of gave a vague indication that maybe this is not a done deal, this 25% on Canada and Mexico. He said that the exact tariffs to be levied against Mexico and Canada are still, quote-unquote, fluid. But the additional 10% tariff on China is final. That's intact and that is set, he goes on to say. Now, our own Commerce Minister, Mr. Piyush Goyal, is traveling to the US, and he'll be meeting, among others, in all likelihood, he'll be meeting the US Commerce Secretary, Mr. Lutnick, and also the US Trade Representative, Jameson Greer. And this becomes extremely critical. Can they stitch together a mutually beneficial, a coexistential kind of a trade agreement before those reciprocal tariffs kind of hit upon us? So this meeting that the Commerce Minister will have in the US is absolutely critical. Starts today, goes on for the rest of this week.Quickly coming to the brutal sell-off. Now, the numbers were massive on Friday. Look at the selling. FPI selling of about 12,300 crores, of 11,600 crores, offset by domestic institutional buying. But the numbers and the volumes are absolutely gigantic. The total selling so far in this calendar year has exceeded 1 lakh crore rupees. It's much higher than the selling that we got in October, November of last year as well. That's the total damage in terms of the FPI outflows. Some more economic data points for us here in India. They're actually largely okay, neutral to slightly positive. The Q3 GDP number is in line with estimates. Q3 GDP is at 6.2, much better than the howler that we had in the second quarter. And of course, it's lower than last year, but we know that. The full year GDP estimates now, the second advanced estimates for the full year FY25 stand at 6.5%, a marked deceleration from 9.2%. That number, the previous year's number, was revised higher. So look at the disparity in growth in terms of the expectations for FY25 and where we were last year. Talking about the 8 core industries data that also came out after market hours on Friday, those numbers are kind of, muted, 4.6% versus 4.8%. So 8 core industries are not firing. Cement is, by the way. Watch out for the cement output numbers. Look very, very good in the month gone by. Otherwise, it was all largely sort of neutral. The auto sales, and we'll have more clarity on this as we go along, largely barring Mahindra & Mahindra and Eicher, it's been muddling along. It's very sluggish for automakers like Maruti, where the numbers are actually down 1%. Mahindra & Mahindra, fantastic numbers, 19% up on passenger vehicles. Their tractor business is firing 18% higher. And Eicher has done very well on those Royal Enfield motorcycles. Those numbers are looking very, very good as well. So we'll watch out for a lot of these stocks. I just want to end again by putting the damage in perspective and why we're saying maybe we're close to the end of this long, dark tunnel. This is February. Nifty is down 6%, mid-cap index 11%, small-cap 13%, the micro-cap index down 15%. And it's the spread is across sectors. Nothing has been spared. Like Prashant mentioned, even IT, pharma, all the indices are down. And now we are close to wiping off our full one-year returns. In fact, on the Nifty, the one-year return is just 1%. The mid-cap index is down 0.5% for the full year. Small-cap index is down 7.5%. So basically, the market's wiped out entire 12-month gains as well. The sell-off is all-encompassing. It's absolute, it's huge. But these are the kind of levels, Nigel, where long-term buyers know that this is the best time to get in the market if you want long-term wealth creation.
Well, that should ideally be the case, right? And economic activity should pick up from here on. Capex spends as well in the last 2 months of the fiscal year is normally very, very good. And as you said, cement output as well, the production is looking very, very good. So there are signs that the economy actually is in quite good shape. And the RBI governor as well, the steps that have been taken are pro-growth. So that's all good. But let's talk about the markets then. What do the FIs do? Not just they're selling in the cash market, they're adding shorts, and they're adding shorts big time. And that trend continued even in Friday's trading session. So they added close to around 15,000 short positions. The total positioning is at around 85%. And if you look at it, look at it closely, this is on index futures. The shorts seem to be added on the Nifty, because the Nifty Bank, the open interest wasn't very, very large. And if you look at the bifurcation as well between the FI action on the Nifty as well as on the Nifty Bank, the higher amount of shorting is actually on the Nifty. And the Nifty Bank actually in the last few trading sessions, in the last 1 month or so, it's actually done a relative outperformance, because it's falling a little bit, but it's actually falling less than what the Nifty is falling. So, and if the markets need to bounce from here on, the Nifty Bank will need to play a very, very crucial role out there. Remember, the FIs have a highest amount of exposure to the banking as well as the financial pack. But the Nifty Bank is showing signs that there is some buying at lower levels, and that will have to fight back for the bulls from here on. So I'm going to keep an eye out on the Nifty Bank itself. Moving to a few technical factors. If you had this sort of a screen, you'll be saying that, in fact, a bounce is very much due, because the RSI, well, it's up the 25-odd mark, and it's clearly indicating that we are in a bit of an oversold zone just in the near term. And that could be a reason why we see a technical bounce. The FI net short positions at around 1.9 lakh contracts, that as well is at an extreme end. And the PCR has gradually cooled off. It was at around 1. It's cooled off to around 0.78. Normally at around 0.65 to 0.7 is where you see a bit of a bounce. So all those factors, in a normal market, you say we're bracing for a bounce. The problem is sentiment is hurt, and the FI selling has been very, very aggressive. Moving to the options data, well, a couple of strikes come up for you on the screen. And just going by the options data, you get your broad levels. So on the upside, the level that you're looking at is 22,350. That's going to be extremely important, and that's going to be a bit of a resistance zone. So 22,350 is the resistance. On the downside, you're looking at this 21,800 to around 22,000. Extremely important support zone. This level needs to hold out, and then gradually we can see a bit of a fight back. So that's going to be important as well. The stocks that I'm looking at post the con call is Ultratech, as well as all the cables and wires players. Why is that? Because Ultratech had a con call, and on the con call they clarified they're not looking at any new vertical. So that's good news, because the street didn't like them diversifying too much. Besides that, they're saying that they're not looking to suppress pricing, and they believe that there's enough market opportunity for everyone to survive. And that will be very, very good news, actually, not just for Ultratech shareholders, but also the other names, Havells, KEI, Polycab. All these stocks will be in focus post Ultratech's con call.
Okay, all right. Got it. Just the memories from the pain sector, I think, were still haunting people on the street when it came to cable and wires. But those are important takeaways from the Ultratech con call. Let's get started then with the equity call of the morning. Venugopal Garre of Bernstein expects an economic revival to play out in the second half of this calendar year, with rural recovery likely marking its stamp of approval and stress in the lower end of the pyramid easing. However, they don't see a single factor becoming too dominant to direct the markets in this recovery phase. He adds that with growth not expected to move materially above 6.5%, market will continue to be led by volatility and external events and affected by Trump policies and no large near-term rate cuts. He says with the Nifty inching closer to the bottom, they continue to see a case for selectively buying large caps. He says they would avoid smaller names in this phase as they find it hard to justify the small and mid-cap bubble. Still calls it a bubble.
Okay, well, the Trump and Ukraine's President Zelensky, of course, met in the White House and actually clashed in the White House. That's basically the way to put it. So there was, those visuals you would have seen, a full day of sort of meetings, etc. Then there was a press conference which was scheduled, and that press conference was just a briefing before that minerals deal was supposed to be signed, where U.S. gets access to develop Ukrainian mineral and oil and gas assets, etc., in exchange for mediating a peace between Ukraine and Russia. And it was just supposed to be, things looked like, if you watch the full 50 minutes, things were actually going pretty well, except the last 10 minutes or so, and specifically the last 7 minutes when it really all kind of went up in smoke, and there were arguments in front of TV cameras, and then Mr. Zelensky was actually asked to leave the White House. It was a complete disaster, which really played out in that sense. What does this now mean? Of course, in terms of just watching this, it kind of opens the doors in terms of what happens behind the doors, because you don't see this very often. I don't think we've seen this at all. So raised voices, tension, etc. But what does this now actually mean for the peace process? Because markets have been, at least, some markets have been pricing in a peace deal, which was imminent. Does that get pushed out now? Ed Yardeni is president at Yardeni Research. Ed, good morning. Good to have you with us here. Thank you for waiting. What does this mean, Ed, according to you?
Well, I think we've already seen one obvious reaction to what's going on, and that is defense stocks have been very strong in Europe. I think there's a growing sense that the whole NATO structure is being questioned. The commitment of the United States to defend Europe is being questioned, and certainly the commitment of the United States to defend and help the Ukraine is certainly being questioned. But you put it all together, and it's going to force the Europeans to get their act together, which could be a positive. As you know, the stock market there is doing extremely well. It's partly because it's cheap, and maybe it's partly because they are going to have to respond to this changed geopolitical situation, the new world order that seems to be emerging by becoming stronger, more united, and having more of a direct policy. So I think that's actually turns out to be a positive for the global economy. It might actually allow the United States to cut back a little bit on defense spending, simply because the Europeans will be picking up more of their own spending. But I think for the stock market in the United States, as we saw when the acrimony, when the dispute was going on in the White House, the stock market sold off, but then it had a nice rally at the end of the day. I think at the end of the day, what really matters here is the economy, and there's been some concerns that the economy is weakening. I think a lot of that had to do with weather. January was the coldest month we've had, a January month that we've had since 1988. And so I'm expecting to see a pretty nice rebound here in retail sales, employment. And so I think a lot of this concerns about a soft landing, a soft patch, a recession, I think that'll evaporate just the way it did during the summer of 2023.
That's interesting, Mr. Yardney. And you've been maintaining a positive stance on the U.S. economy and the U.S. stock market for a while, and you've got it right all along. So you're saying that this is just maybe a transitory phase. So not too concerned about those numbers like, the consumer spending number, retail sales. There was this Atlanta, Fed GDP tracker, which is predicting, a drop in GDP in the first quarter. So you don't see this as being a concern. What about tariffs? When people are getting worried about what it does to inflation, and if that's a reason for the market to take some profit off?
Well, what just happened with the estimate for real GDP is very much related to the question that you just asked about tariffs. Clearly, a lot of importers decided to get moving faster and to bring goods into the United States before the tariffs are slapped on them. So we had this huge increase to a record high in imports. And when we calculate real GDP, we subtract imports from that number. And so it was sort of this anticipation of tariffs that led to a huge increase in imports. At the same time, consumers didn't really spend much. Actually, consumer spending went down in January because of the bad weather. So it all added up to a sharp fall in real GDP. I think a lot of that's going to be reversed. I think the first quarter is still going to come in positive for real GDP at 1.5% to 2%. With regards to the tariffs, this is the art of the deal. To remind us of the book that Trump wrote and kind of what he views as his modus operandi, how he gets things done. What's unusual, as you folks said, is that it's so public, and it was pretty ugly to watch on Friday. But it is deal making. It's not a pretty sight, and I think at the end of the day, we're going to find that there's going to be a lot of negotiations that actually lead to lower tariffs. I think that's really the point of all these reciprocal tariffs that the United States is imposing, is say, we're just not happy with the current trade situation, and we need to have it improved. So I think this all ends well. I don't think it ends badly.
Okay, all right. Then what would that mean for the stock market, Ed? You were calling for a couple of months ago that the U.S. markets could cool off a little bit. That's happened to some extent. Yeah. Where do you see the U.S. markets headed from here on? And what about the Indian markets? Yeah. We've been under the weather, for the last few months. Post this correction, and since the economy appears to be improving on ground, what's your view on the Indian markets?
Well, with regards to the U.S. stock market, I did think we were going to have a cooling off, a pullback, maybe even a correction in January. January turned out to actually be a strong month, but I think we're experiencing that choppiness right now. We haven't made a new high. Well, actually, we made a new high February 19th, not too long ago, but it's really been kind of choppy at this kind of record high level for a few months. And I think it remains choppy until we get through the fiscal deficit budget negotiations that are coming up here in mid-March. And then I think the market goes up on better than expected economic growth, better than expected earnings. And I still am using 7,000 as my target by the end of this year for the S&P 500. With regards to the Indian market, I think what we're seeing is that global investors decided that they had too much in the Indian market. The valuation multiples got stretched, and they saw an opportunity to rebalance their portfolios more into China, more into Europe, and those stock markets have done well. And now I think it's back to the fundamentals. And as you said, the fundamentals for India still look pretty good. The stocks are cheaper now. And so I think we're going to find a bottom here. But we may have some consolidation for a while before we resume the climb towards the previous record high. So I think it's kind of the same story for India and the United States stock markets. A great performance, some need for profit-taking consolidation. The underlying fundamentals are still quite good. Global investors will diversify back into India and into the United States.
Okay. All right, Mr. Yardini, we will leave it on that note for this morning. Thanks very much for joining in. That's good to hear. I think the market participants in India will even take consolidation with both hands as long as the fall stops. Well, let's kick it off and tell you about all the voices that you'll hear on the show today. Lots of corporate interactions are lined up. Coming up at 8:35, we'll start off first with Prakash Diwan joining in, talk about a couple of individual stock ideas and how to approach this market after the brutal February sell-off. At 9 a.m., we will have Kumar Rakesh of BNP Paribas joining in to talk about the key trends in the auto sector now that most of the sales numbers have trickled in. At 9:20, Karthik Kumar of Axis Mutual Fund joins in. He's our market master of the day. At 9:30 a.m., we will be chatting with the management of Info Edge, talk about some of the hiring trends and what really are the anecdotes from the real economy. Following that, we have coming up at 9:40, the management of IGI coming up to talk about their performance. They've come out with their, of course, quarterly results, and they'll share the outlook with us as well. A little later at 9:50, in our special segment Charting Technicals, Biju Samuel of Elara Capital joins in to talk about the market outlook and whether a bottom is finally forming now. By the end of the show, in our special segment, It's the Economy, Lata will analyze the GDP data in detail with economist Sonal Verma of Nomura and Madhvi Arora of Emkay Global Financial Services.
Time to slip into a quick break, but we've got a lot of stock-specific action we're going to be tracking for you in our special Top 10 segment. For the time being, we're running through the list. We're looking at Ultratech, Mahindra & Mahindra, TVS Motors, Aichi Motors, and Dalmia Bharat. All of them will be reacting to positive news flow. And 5 apiece today, we have Hyundai, Maruti, Tata Motors, Coal India, and Hero MotoCorp that will be reacting to negative news flow. Stay with us.
Welcome back. You're with us on Bazaar Morning Call. Let's, get to the stocks. Of course, we have to watch out for the wider market, and the anticipation is that we will get a bounce back, a recovery, not just in India, but the implied open has been telling us. I mean, it's a global recovery that we've seen Wall Street, Asia this morning, and therefore we should be in step with that, almost 90 points higher. Now let's talk about some of the individual stocks that we have to track because there's been plenty of news flow. So our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning. Okay, I have two of you right now. So morning to Sudarshan and again morning to Nigel. Nigel, let's start with that Ultratech call that caused such a flutter while I was away on these wire and cable stocks. What are they saying now?
I think Ultratech's con call gives relief both to the shareholders of Ultratech Cement, and the cables and wire stocks as well will do well in today's trading session. And here's why. First, the basic details. Ultratech said they're looking at an IRR of around 25% and ROC of more than 20%. That's great. Wires and cables mix, they'll be looking at close to around 60% wires and 40% cables. And they also mentioned that their raw material sourcing, particularly of copper, will come in from the group company Hindalco, which is good news for them. But now let's get to the crucial takeaways. They say that it's a one-off strategic diversification that's targeting higher customer wallet share. So that's point number one. Second, they clarified that they're not looking for any other new business opportunities. That will be a relief for Ultratech shareholders as well. And what will be a relief to cables and wires players will be that they do not expect pricing pressure to disrupt the industry on the whole. So they're not going to be looking at, cutting pricing out there. They believe that profitability is there and the market is large enough for everyone. So all of that will be a relief both to Ultratech shareholders as well as to the cables and wires players. What our brokerage is saying, DAM Capital is saying the recent stock price correction in Ultratech seems an overreaction. They're saying the investment is nominal. It has potential advantages in place. And the ROC is going to be more than 20%. Currently, the core business ROC is just around 12%. Jefferies as well, they derive comfort from the commentary on the future capital allocation. They remain confident of the company's commitment to the cement leadership. So put all this together, all the stocks should be in the green. That saw a sharp sell-off in the last 2 or 3 trading sessions. So that's about the cement space. Let's hop across to Sudarshan. He's been busy over the weekend tracking the auto sales numbers. Morning, Sudarshan. Run us through.
Morning, Nigel. So as expected, the number of companies missing estimates is much more than the ones which have reported higher than estimates. But we'll start with M&M, which has outperformed the peers. For M&M, both auto and tractor segments have reported numbers which have come in better than estimates. For auto segment, the one segment which has been leading the growth is SUV. For SUV, growth has come at 19% with total auto sales rising almost 15%. Tractor sales too saw a jump and it was up 18%. As far as Hyundai is concerned, for Hyundai, domestic sales remain a drag. Domestic sales saw a drop of 5% while exports have risen 7%. Company said despite geopolitical challenges, it remains optimistic on demand even on the domestic front going forward. For Maruti, sales were higher year-on-year, but it has missed estimates. And the problem for Maruti remains the entry-level segment. Both Alto and Espresso, sales for both these companies together have seen a fall of 31% year-on-year, while utility vehicles or say SUV segment continues to lend the support, and for this sales were up 6% year-on-year. Last one is Tata Motors in four-wheeler. For Tata Motors, most of the segments see a sharp drop. Domestic sales were down 9%, CV sales saw a fall of 7%, even electric vehicle sales were down, and for this sales were down 23%. So except M&M, all the companies in four-wheeler space have disappointed in February.
Okay, all right. Thanks a lot for that. Sudarshan, I'm going to come back to you for more. But for the time being, let me tell you about Coal India. Actually, the February dispatches numbers were disappointing from Coal India. So it was down by close to around 5%, came in at around 62 million tons or thereabouts. Morgan Stanley, they have come out to their note. They maintain the overweight rating on the stock, but they say that the sharp moderation in offtake was a negative and it could weigh on Q4 FY25 as well as FY26 earnings estimates. So, you know, the number for the past month was quite disappointing, though that additional revenue that they're going to be getting of around 3,800 crores, that's good news for them. Additionally, they put out, announcement on the exchanges. They've given some relief to the non-power sector customers through financial coverage waiver. This move basically is towards efforts to streamline the operations under the broader ease of doing business. So because I think, they're having a bit of a problem with regard to the inventory, they're having, a higher amount of captive coal coming into the market, which is reducing the dependency that some of these players had on Coal India. So that's why they've gone ahead and they've tried to streamline the operations. Nonetheless, because of the weak print that we saw in February, going with a tinge of red on this particular name. But Sudarshan, coming back to you, more auto sales numbers is what you're tracking. Tell us more.
So as Maruti's numbers indicated that there is a pain in the entry-level segment. So similarly, that's the reason we are seeing a sharp drop in Hero MotoCorp numbers. Amongst all the two-wheelers, Hero Moto is the one which has disappointed the most. And for Hero Moto, total sales have slipped 17%. Also, it has missed estimates by almost 12%. And there is a sharp drop in motorcycle sales. Remember, Hero MotoCorp is the leader in the entry-level segment. Its share is much higher than if you compare with Bajaj Auto, TVS and other companies. And there is a drop in motorcycle sales, and sales for this have come down by 20%. Now, in contrary, Eicher Motors, it saw a all-round increase in the numbers. Total sales were up 19%, and up to 350cc for this sales were up 17%, and above 350cc sales were up 33%. For TVS Motor, exports have led the support and sales were higher than estimates. Total sales were up 10%, while domestic sales saw a minor increase of 3%. For TVS, exports have lent the support, and that's the reason you are seeing the numbers higher than estimates. So red for Hero Moto, green for both TVS Motor and Eicher.
Okay, all right. Thanks a lot for that, Sudarshan. Well, I'm also looking at Dalmia Bharat. They have gone ahead and they made a big announcement. They're looking to add 6 million tons of cement capacity in Maharashtra as well as Karnataka. The markets have targeted is Belgaum, that's a brownfield expansion, while in Pune, it will be a greenfield expansion. Total investment they're looking to put on will be around 3,500 crores, which will be funded via debt as well as internal accruals. And they're saying that these units should be commissioned by Q4 FY27. Now, Dalmia Bharat, well, the total installed capacity will move to around 55 million tons or thereabouts. So this move is seen positively because they're moving a little bit away from their core markets, which has been the northeast part of the east as well as north as well as south. So they're moving to this belt, which will be moving to the western region. So that's why it will be viewed positively, going with green on Dalmia Bharat.
Okay, all right. So with that, let's quickly recap our list of stocks to watch. The ones that have positive news flow are Ultratech Cement, M&M, TVS Motors, Eicher Motor and Dalmia Bharat. Stocks that have negative news flow today around them are Hyundai, Maruti, Tata Motors, Coal India as well as Hero MotoCorp. So lots of auto names on the list today. Let's move on and talk about commodities now. We have Manisha joining in with a roundup of all the action. Manisha, so morning to you. How is it looking?
Well, I can say one thing for sure today morning, that most of the commodities have started the day on a positive note. That is because the dollar index has come off its 2-week highs, and then metals also are gaining on strong China PMI data at a 3-month high. The China factory activity for the month of Feb has expanded to 50.2. That clearly seems to be supporting many of these commodities. I'll start with crude oil prices, where we are looking at nearly a percentage point of gains in Asia. Prices did close the month of February as the first monthly decline in 3 months, but we've started slightly support. Strong, 1, on strong Chinese data. 2, because of the decline in US dollar. 3, you are looking at those tariffs coming in on Mexico and Canada from US that take effect of March. So the markets are slightly choppy ahead of that as well. And the additional 10% tariffs is something yet again that the markets are working with. So volatile, but some strength coming back in crude. Same is the case with the metal prices as well, because of the strong Chinese data and expectations of more stimulus measures coming in from China. For the gold prices, while last week was a very bad one, and we are off nearly $100 from its all-time highs because of profit taking and because of the stock market losses, stoking deleveraging pressure in gold. That is what really has been impacting the prices. But today is the day. Asia is the market that you have seen many of these tangible commodities start on a positive note.
Okay, all right. Got it, Manisha. Thanks very much for that indeed. Those PMI numbers from China helping the commodities complex. Thank you for that. We'll take a very quick break. On the other side, we'll be connecting with Prakash Diwan and talk about some individual stock ideas.
Welcome back and hope you're having a good morning. Well, India's Q3 GDP was announced after market hours on Friday. It came in at around 6.2% in line with CNBC-TV18's poll. The previous year's GDP numbers were also revised higher. Lata joins in to break it down for us. Lata, morning.
Well, the GDP numbers are definitely exhilarating. First, at 6.2% third quarter compared to 5.6 Q2, which had given everyone a heart attack. It clearly shows that the economy has turned the corner. Clearly bottomed, and that sub 6% is a one-off. Now, within that also there's a lot of positives you can pick up. Look at the sectors that have pulled the GDP up. Agriculture 5.6%, construction 7%, trade, hotels, transport, these are all informal sectors. You know, the Udupi hotels, the ST buses, that's grown 6.7%. Real estate and finance, again, employment generator, grown by 7.2%. My point is the economy has been bumped up by the employment-heavy sectors, which is a positive. Now you look at GDP from the expenditure side, private final consumption expenditure has gone up by 6.9% in Q3. The forecast for full year is 7.6%. And look at the difference from FY24, 5.6 in FY24. That's a substantial growth in consumption. And again, with these employment-generating sectors doing well, hopefully the consumption would keep up. Of course, there are weak points. Manufacturing, only 3.5%. And gross fixed capital formation, which was the engine of the economy, has clearly slowed, 5.7%. Actually, if you dig into the internals, private investment is clearly not picked up. Now, the forecast from the Ministry of Statistics, that is from the National Statistical Organization, for full year is 6.5%. If you do the math, 6.5% for the full year and 6.1% for the first 3 quarters average, then you have to deliver a 7.6% for the fourth quarter. there can be questions over that. The CA made a very impassioned plea. Excellent growth in services exports. Mahakumbh has generated a huge amount of economic activity, and the government is spending 50% capex more than a year ago. Together, probably a 7% plus can be delivered. And then, of course, the Q3 and FY23, FY24 GDP has been hugely bumped up. FY23 bumped up by 40 basis points to 7.6. And just look at FY24, 8.2 was the previous number. The revised number is 9.2. Now, what we should take home is that the base year for Q3 was 60,000 crores higher than when we were making the forecasts. In spite of it, the growth has come at 6.2%. In spite of the base getting bumped up, all these looks like it's a very positive number. And Q4, the current quarter, if the consumption is, if the growth is really over 7%, then one hopes long-term investors like FPIs will start, at least stop sell-off or start buying ahead of the number.
Okay, Lata, thank you very much for that. I was there at the time of Mahakumbh, so I saw it in front of my eyes. How much of it really gets captured in the data and the numbers we have to see, but incredible amount of economic activity on ground taking place. But let's go forward and discuss some stock ideas with Prakash Diwan joining in. Prakash, hi and happy Monday to you. We hope it's going to be a happy Monday after that brutal Friday. What's the sense? Just at a market-wide level, what is your buying list looking like today? Because a lot of the foreign brokers, if you listen to them, they're saying just buy large caps. That's where safety is. Buy big banks. But the tendency usually is for retail to try and pick those mid caps that were out of reach because of high valuations earlier. How are you approaching this market after what we've seen last week?
Good morning, Surabhi. So I think it's a bit too early to see any kind of a buying comeback meaningfully within the small caps and mid caps. Of course, the classification of small caps and mid caps is still way beyond the threshold that retail investors like to dabble in. And you could probably call them micro caps or something, which will be less than 2,500, 3,000 crores market cap. That will only happen when you probably have FIs coming back. There's this whole momentum that the market is seized with, so it could take 3 months, 4 months. But I think there's a lot of value picking that's possible. And you're spoiled for choice, actually. But it's just that nobody is willing to commit all the funds at one go because March is expected to also see some bouts of sell-offs, maybe because of tax considerations and tax loss harvesting or whatever it may be. But I think large banks, private sector banks, particularly the likes of HDFC, Kotak, they definitely seem to be more resilient than before. What I would avoid is some of the auto names. The M&M has shown very good numbers. But there could still be some time before the revival happens in terms of the mood for these stocks. And look at how the market responds. You have Ultratech announcing a cables and wires foray, and all these stocks, the other stocks, got hammered. The reason is even after they actually got hammered, they're still at 60 plus kind of P multiples. So the market is still expensive in certain pockets. So I wouldn't say I wouldn't dare to kind of start buying into it, but I think defense will start seeing some value buying very selectively. Some of the smaller names which have fallen along with the other big ones. You could have some names in power which could start looking up, but we're still not buying for sure. We would rather wait for another week, 10 days for March to kind of settle in, the month to kind of get it moving, and then remember earnings will take center stage. So earning expectations will take center stage. So it's going to be a very heady cocktail of global geopolitical. This thing and of course domestic news. There's no domestic news flow that's very positive except for the GDP print. But I think the smart money will start coming in probably end March, early April.
Okay. Hi, Prakash. Good morning. In fact, talking about power demand, I had a chat with Mr. Praveer Sinha of Tata Power, fireside chat at the Forbes event on Friday, and he indicated that power demand is quite good. So that should be indicate that the economy as well is doing pretty okay. That aside, since you briefly mentioned Ultratech, what's your view on the stock? You're getting it 20% cheaper from the 52-week high. They put out clarification on their con call. They're saying that this is a one-off. They're just looking at getting a higher amount of the wallet share of the customer. They're not looking to disrupt the market via pricing. And also, they don't have any more plans to do further diversification. The street will read that positively. Your view on the stock? It ended at the low point of the day, even in Friday's trading session. Post the announcement, I think it's lost close to around 8% of its market capitalization. Your take?
Good morning, Nigel. So you're right. There is concern that the return ratios, the ROCs for the business would for the stock would start getting much more stressed. And remember, the Grasim Opus foray is probably encourage the fact that even Ultratech would get into something which is like an adjacency, which helps them increase wallet share. But it doesn't come so soon. It doesn't come without a lot of investment that will have to go into all this. So there's still some time. When Grasim announced it paid for it took them 2 years to really start coming into the market and making a difference. So I think it's going to be a while before that happens. So I would be overtly worried. It's about what kind of investment they make into the production side, the operation side. That will probably decide. But Ultratech, on a standalone cement, focused business, is definitely poised for a very good, run going ahead. And so are some of the other names also. I mean, you look at the news flow in Dalmia. After a long time, they talked about expansion, and especially in pockets where they otherwise were not very significantly large. So it's going to be a lot of availability of opportunities in cement. I think cement is one of the cyclical sectors which will start doing well. But I would still look at something like a Dalmia Bharat, given the fact that it's also consolidated. Whatever had to happen has happened.
Right.
And you could continue growing from here.
So Dalmia would be your preference from the cement pack, right?
That's right. Yeah.
Okay, and diversification, as you said, they look at a new market, which is good. But since we were on the topic of cables and wires, a lot of people believe that post the fall that we saw on Polycab, KEI, Havells, it could actually be a buying opportunity post the commentary of what we heard from Ultratech. Do you think the same? Because paints and cables and wires, as per what industry experts say, is very, very different. Whether you look at the fragmentation of the market, over here there were just a few players that had bulk of the market share. Would you think so? Do you like any of them?
Yeah, so that's a very important point you made, that cables and wires actually don't have, the paints doesn't have any unorganized play, whereas cables and wires, there's a lot of fragmentation on the lower end. And there is room for somebody else to come and get, into the organized segment and increase market presence. But the concern is, as I said, KEI, Polycab, Diamond, all of them are still trading at multiples which are 60 plus. So it's something where, we actually accorded them high multiples because of the kind of growth that they have. But the margins and growth rates could probably taper a bit organically. It's got nothing to do with Ultratech's presence. And at 60 times, you're probably priced to perfection. So that's where a bit of a concern is. So I would wait for some softer valuations if I had to look at the other names that you mentioned.
Okay, Prakash, stay with us. We're going to take a quick commercial break here. We'll get the techies in as well to assess the price action. So Sudarshan Sukhani and Mitesh Thakkar join us to help us do that in just a bit from now. Stay tuned. Okay, welcome back. We got, 8 minutes to go for the pre-open session. The GIFT Nifty will come up on your screen, gives you a quick sense of how we likely to start. So there is about 100-point recovery, at least the word go, afoot. Sudarshan Sukhani is with us, and so is Mitesh Thakkar to run us through what they're making of price action. Gentlemen, good morning. Great to have both of you here. Mitesh, you go first. Again, the question every Monday for the last few has been, are we there yet? Tough to answer, but take a shot at it.
Good morning, Prashant. So I think, as of yet, there is no sign of a reversal, except for the fact that now we're getting oversold on weekly charts as well. But there has to be some kind of price action which should confirm that the direction will change. And I think we are clearly lacking over there. And the first pivot on the upside would be the gap which the market had on Friday. So till that gap down is being captured, I don't think we should look at any significant reversal. Until then, I think it will be a sell on rallies kind of a market. The gap down actually is between levels of 22,450 to about 22,500. So that 50-point range, I think till that has been captured, I don't think we are looking at any kind of significant reversal happening. In fact, a lot of stocks with the kind of decline they've had in the last 2 weeks, they've also turned negative on the weekly and the monthly chart. So I think we might be in for some more time of volatility. Though, of course, you will get this bouts of small short covering bounces. But a bigger reversal, I think, as of now, I'm not looking at it in the next couple of days.
So you'll be looking at shorting the bounces?
That's right.
But to bounce to what? Hourly averages first, Mitesh? I mean, so is there a trade today, this morning, on the index?
Yeah. So, Prashant, if you get closer to about 22,300, which is slightly bit far-fetched, but then I think that's the area where I would want to short, because then the risk-reward equation comes into play with a slightly favorable outcome. Or the other way to do it is what I've been doing in this entire decline, is to have some put option spreads on the Nifty and the Bank Nifty. I think that works well. See, the Bank Nifty again, has not yet declined below the lows which it made in January. So I think if the Bank Nifty breaks 48,000, that will give you a fresh breakdown on the index to trade. But I suspect that might or might not happen, because stocks like HDFC Bank are still showing good strength on the chart. So my focus would be on the Nifty, and if I don't get a good entry point on the future segment, I think a put spread is what I would recommend.
Got it. Okay, all right. Sudarshan, let's come across to you. How are you feeling this morning about the markets? Is there a trade first on the index?
Yeah, good morning. Well, the Nifty, there's a process to say that the market has stopped falling. Either we have a one-day reversal or a two-day reversal, which essentially means the markets fall, then either on the same day or the next day they bounce back and recover the losses. Then they should start trading in a range, and that range should eventually break on the upside. So this entire process takes time. It has not even started. So as far as the Nifty is concerned, I don't think there is a buying opportunity here. Neither is there a trade. I don't think we should be looking at shorting. I don't usually do Nifty shorts, so I just stay away. That is my suggestion. Step aside for the Nifty, but there is a trade in the Bank Nifty. Now, that trade is obviously, with all the market conditions, it's a slightly high risk trade, but it's there. The Bank Nifty has fallen thrice to the same levels. It has not broken it. I would say if the Nifty gives signs of, if the markets give signs of some stability, go long in the Bank Nifty, keep a 200-point stop loss, not much, but you might be surprised on the upside.
Okay, Nifty Bank is the one that Sudarshan likes. Sudarshan, so what about individual stocks? What's on your radar?
Well, Bandhan Bank is a buy with a stop under 138. Aditya Birla Capital is a buying opportunity, stop under 154. I have two intraday shorts, both FMCGs of some kind. Jubilant Foods is an intraday short with a stop above 636, and Tata Consumers is an intraday short with a stop above 985. Don't double in the Nifty. It's not worth it.
Mitesh, what about you?
I also have a mix of buys and sells. For me, HDFC Bank is a buy at the stop at 1710. Look for targets of 1775. Jubilant Foods on a mild pullback around 630, 632 is a sell. Keep a stop at 644. Look for targets of 605. MCX is a sell with a stop at 5060 for targets of 4850. And Voltas is a buy with a stop below 1300 for a target of 1355.
I have a few other questions, and we'll come back with both of you in a bit. But thank you very much for joining us. Good speaking with both of you and getting that opinion. Well, we'll take a quick commercial break here. We're going to come back in just a bit from now. Prakash is with us, but Kumar Rakesh of BNP Paribas will also be joining in to discuss the Feb auto sales data. Stay tuned. Okay, welcome back. 15 minutes to go for the market open and about a minute to go for the pre-open session. Prakash Diwan is with us, and we've been talking specific stocks, cement, wires and cables, etc. Prakash, rapid fire. Let's go back and forth on a few things. One is IT services. The IT index, after not falling, fell 10% in the last 7 days. I reckon that was on US growth fears. Because over the last 1 week, US markets also started correcting a little bit. But, as people like Ed Yardeni, etc., in the morning told us, maybe growth fears in the US are exaggerated. There was a very harsh winter in January. There's a lot of pre-buying before tariffs take hold. So imports rose very sharply. So actually, U.S. economy should be fine, at least that's the expectation. What's your sense? Anything worth buying there in the IT services space? Stocks themselves sold off 8-10% last week.
No, so Prashant, I think the simple explanation is IT within India hadn't fallen off. So it was bound to kind of join the bandwagon. It did towards the latter half of February. But my sense is the revival will still be some time away because there's absolutely nothing in terms of new contract wins that have come in for any of the large names, right? So in fact, the mid-size IT names will probably be beaten down even more. So I would stay away. There's a lot of money allocated towards Chinese IT businesses that probably will go away, and the FI money will take time for most of the buying in India to happen. So I'm still not very positive on IT. Is the short answer.
I mean, no, I think point taken. I wanted to ask you whether if the 10% tariffs on China take hold, are there any specific sectors but that's, all that is for a normal market, which is responding to headlines one way or the other, more two-way market. This is a one-way market, and it has been that way for a while now. Prakash, thank you very much for joining us. Good speaking with you and getting that perspective. We'll speak again soon. Surabhi, but I think we have the February auto sales data to focus on.
Absolutely. Not too many, bright stars, but yes, there are some that are shining like Mahindra and Mahindra. But let's dive a little deeper in those numbers and what this means for investors. We've got Kumar Rakesh, who is the analyst at BNP Paribas and looks at autos. Kumar, thank you very much for being with us. So we've been pouring through the headline numbers, and what caught my eye was two numbers. One is Eicher Motors in two-wheelers, and one was obviously Mahindra and Mahindra. Let's start with the four-wheeler space first. X of Mahindra and Mahindra, when you look at Hyundai's numbers, Tata Motors, Maruti, I mean, these companies are in serious pain. Do you see any light at the end of the tunnel?
Hi, good morning, Surabhi, and thank you for having me on the show. For passenger vehicle, yeah, the growth has been quite tepid actually for many of the companies. It's been a decline, and that's partly a reflection of the affordability issue. Post-COVID, the affordability of passenger vehicle has materially come down. The prices have gone up for various reasons, including commodity prices and the emission norm changes, and also a lot of premiumization which has happened. But the income growth hasn't caught up to that, and that is something which is showing up on the weak growth which we see. We are hopeful that as we go into the next financial year, and especially in the second half of the next financial year, a lot of this will start coming into the base, and we should start seeing some recovery on the growth numbers. But that being said, as of now, definitely outside of Mahindra and Mahindra, we definitely see growth not being around for most of the companies.
That's interesting. Affordability issue, one would imagine it would be for everyone, but M&M's done something right. Coming at the price points they're coming, they've still managed to do so well through this entire phase, right? So Kumar, in the four-wheeler space, so what stocks do you like, if any?
The top picks are Mahindra and Mahindra, obviously, and Maruti Suzuki. Mahindra more for the next 1 year. We continue to see these growth momentum to continue for the company. We think Mahindra would be one of the fastest growing automotive company next financial year as well in FY26. They would be in FY25, but in FY26 as well. And the second reason is because of the model launches which they have done. Some of them are yet to come into the base, and hence we'll continue to see strong contribution. That is Mahindra 3XO, Thar Rocks. They have been launched later part of the last financial year, so we will continue to see some incremental growth because of them. And also their new BEV models, the EV models which they have recently launched, they will start contributing to volume. So all of that put together, we see a good visibility on the volume growth of the automotive business. Their farm equipment business, the tractors also are reporting pretty solid growth. They have been gaining market share in a market which historically haven't seen dramatic market share movement. They have started entering into the lower horsepower segment, which is helping them to some extent. And hence their second part of the business, which is tractor, also seems to be doing pretty well, and hence seems to be well placed on both the businesses. Maruti Suzuki, more for a longer term catalyst, we see them continue to deliver very solid growth in the export market. In the domestic market, we believe that while the entry segment is struggling, at some stage, once they start rolling out their series hybrid technology models, that should start helping them revive their volume growth in the entry segment, and that would start helping them.
Kumar, just to clarify, just that point you said, M&M should be the fastest growing automaker. Are you saying this calendar year or FY26?
FY26.
FY26. And clearly you're not perturbed about this whole Tesla business, right? Which led to this 15% drop in the stock.
We are not, actually. If you look at above 20 lakh price point in India, we do have sizable volume. About 1 million units, we estimate, is the market volume above 20 lakh price point. But the challenge with the largest EV maker is that most of their products currently are at a price point which is way above that, close to 40 lakh if we include, above 40 lakh if we include the customs duty, even the reduced custom duty. And hence they would need a much lower price model, which we don't have any clear visibility on that they are going to make a lower price model. And in the absence of that, it doesn't make sense to have a local manufacturing, because to have a plant, any OEM would want to have a clear visibility out to about 200,000 units of local volume. And if we don't have that without a model priced at $25,000, below $30,000 price point, it is difficult to justify a local plant. And in absence of a local plant, a price point that low, it's difficult to see material disruption from any newcomer.
Slightly offbeat question, Kumar. Morning, Prashant here. Usually, we ask whether there's a wealth impact going to come through because the stock markets have corrected. I mean, it's not a small segment now, right? 12 crore demat accounts, I think unique, right? So, and portfolios, etc., have taken a hit. On the premium end for vehicles, and that's where the excitement about players like M&M, etc., comes through. Do you think, I mean, I know there's no way to estimate, but do you think that will be a factor if markets don't recover?
Hi, Prashant. Morning. That's a very fair point, actually. That is something which we are also concerned and closely tracking. Pre-COVID, actually, there used to be some correlation between how the market used to do and how some of the wholesale volumes of some of the leading automakers used to perform on the passenger vehicle side. Post-COVID, a lot of data have broken their correlation. So that is something which we don't know how is going to play out, but that is something definitely one needs to closely watch out for. On top of that, there is a pain in the financing market as well. Many of the NBFCs and MFIs are pulling back their financing, given the quality concerns and also the funding cost issues. And that will also have an impact on the rest of the automotive market, especially the two-wheeler, which we haven't discussed so far on this. But we are seeing a material impact of financing pain translating into the slowdown in the two-wheeler industry. So some of these broader macro factors have started impacting the market and can potentially impact and needs to be closely watched for.
Coming exactly to that, Kumar, let's talk about two-wheelers. We're just seeing the Bajaj numbers flash on the screen as we're speaking to you. And sales are down. Sales are down about 11%. Hero sales are down. TVS, I think, is sluggish, just about 3% growth overall. But Eicher has done really well. So what's going on with two-wheelers? Again, Eicher seems to be ending a long period of underperformance. And Bajaj has been the ringleader, but, and now this decline. What do you make of the drop that Hero and Bajaj have seen in February?
Yeah, Survi. So I was on your show a few months back, and we were discussing this, that how financing is going to start impacting the two-wheeler market. If you look at the captive financing arm of many of these two-wheeler companies of Hero, which is Hero FinCorp, they reported a loss in December quarter. Their credit cost has been going up and it still remains elevated. The funding cost had also gone up. If you look at the TVS credit, their AUM growth has dramatically slowed down just to about 7% from what used to be more than 20% just a couple of quarters back. And their credit cost also is quite elevated. So there is a pain in terms of delinquencies for the two-wheeler customers. Possibly they aggressively funded many of the two-wheeler customers, which is now starting to reflect in the credit quality. And that is not just restricted to these captive financing arms. You pick some of the NBFCs as well and look at their credit cost, that has also started going up. And finally, MFIs, if you look at the pain which is there in the MFI industry, one could argue that these MFIs are not directly funding the two-wheeler purchase, but the states where MFIs are the biggest, such as Bihar, UP, Tamil Nadu, Karnataka, West Bengal, the top 5 states, where the MFIs have the largest presence and the AUM growth has dramatically slowed down. The disbursement has significantly come down. The two-wheeler growth also has dramatically slowed down by 15 to 30% sort of a slowdown, percentage points slowdown within a quarter. So there is definitely some linkages in this slowing down of the financing and which is impacting the two-wheeler demand, and which is what is reflecting in some of the numbers which you spoke about. In terms of Eicher, they are not as much dependent on the NBFC and captive financing of as much as some of the other two-wheeler companies are. They are more closer to the passenger vehicle industry in terms of their demography and the customer profiling, more dependent on bank financing than NBFCs, and hence they haven't seen the kind of impact that the rest of the two-wheeler industries have seen. On top of that, they have also pivoted in terms of strategy, focusing more on growth, doing a lot of channel activation, and readjusting their price points. That is something which is also helping the company and decoupling from how the rest of the two-wheeler industries is doing.
All right. Kumar, we'll chat again. Thank you very much for joining us. 4 minutes to go for Market Open. Sudarshan is back with us and Mitesh is back with us as well. 9-10 calls with some eye on what the pre-open is looking like. Sudarshan, you go first.
Well, consider buying Bandhan Bank with a stop under 138. That eye is mainly on the bank Nifty, not on the Nifty.
Okay. Mitesh, what about you?
I'll suggest a sell on Jubilant Foods around 630 for a target of 605 and a stop at 643.
Okay, all right, gentlemen. Thanks a lot for that. Well, let's run you through on the top stocks or the potential stocks of the day. Ultratech as well as cables and wires players. This after Ultratech had their con call post-market hours on Friday. First, the basic details. Ultratech said that they look at IRR of around 25%, ROC of around 20%, asset turns on expected lines 5 to around 7 times approximately. And the split between wires and cables will be around 60% to wires and the remainder will be cables. The crucial takeaways though, Ultratech clarified this is a one-off strategic diversification that's targeting higher customer wallet share. That's point number one. Second factor, they clarified that they're not looking at any other new business opportunities which will soothe the nerves of investors of Ultratech Cement because they were worrying, why are they getting so adventurous? We want them as a core cement player. So that as well got satisfied. And for the cables and wires players, well, they'll be happy to hear that Ultratech said that they do not expect pricing pressures to disrupt the industry. In fact, they believe the industry is large enough. So put all this together, it's actually good news for Ultratech Cement as well as good news for the cables and wires players. What a brokerage is saying, DAM Capital says this recent stock price correction in Ultratech, it seems to be an overreaction. They go on to highlight that the investment is nominal. It has potential advantages in place as well. They also say that the ROC of this foray into cables and wires will be more than 20%. The core business, it gets only around 12% of ROC. So they believe that's accretive. Jefferies on Ultratech, well, they say that they have derived comfort from the commentary on future capital allocation and they remain confident of the company's commitment to the cement leadership. So put all this together, Ultratech is the top gainer on the Nifty today, and you have the stocks like Polycab, Havells, KEI, all of them have opened up in the green. So good times post that con call of Ultratech Cement. But let's get to some of those auto names. Sudarshan joins us to address those flashes on the screen, which is with regard to Bajaj Auto. Sudarshan, how are they?
So it has disappointed. It has basically missed estimates, and one common problem amongst all the two-wheelers is the domestic sales. The reason Hero MotoCorp sales were the weakest amongst all because its domestic sales have higher contribution to total numbers. But it's not the same for Bajaj Auto and TVS Motor. Now for Bajaj Auto also, domestic sales have dropped 11%. Now for TVS, you would have seen that exports had seen a jump of 26%. That's the reason TVS numbers were higher than estimates. But for Bajaj Auto, even exports have seen jump of just 2%, and that's the reason it has missed estimates by more than 2%. Total sales have come in at 3.52 lakh units versus our expectations of 3.60, and if you compare year on year, it has seen a jump of 2%. So because of slowdown in the domestic sales, all the two-wheelers, maximum of them, TVS, Hero MotoCorp and Bajaj Auto have seen a sharp drop in domestic sales. But for Eicher, it was a higher all-round because of the 350cc, above 350cc, it has seen a big jump and sales for that were up 33%. So I'm going with red for Bajaj Auto as well.
All right, thank you very much. So for that, 30 seconds, a little less than that to go for Market Open. We'll have the first rates come up on your screens and we will take it from there. What do we have? I think it should be a little better. Last few days, of course, have been. Actually, even when the start has been good, it's been by close bad. So let's see, this is, we start up and then stay up. About 0.4% higher in the Nifty, 22,200. The Nifty Bank is down about 1%. You got the mid-cap index, which is up about 0.25%. The Nifty Bank is up. I mean, I don't know why it's blinking between being down 0.5% and up 0.5%. It's firmly up about 1/3%. And you got more up than down. That's the Nifty heat map coming into view as well. So you got 35 odd stocks, 34 odd stocks which are higher, the rest which are lower, at least at the word go. So 22,200 plus is back on the screen, at least for now. 1,042 stocks are opening higher and about 760 stocks are opening lower. But very, this is the first minute we are talking about, and things will change as we move forward. But let's look at stocks. Surabhi.
Hopefully they change for the better, Prashant, because otherwise this is a very, very muted start given the extent of the sell-off. Nifty up just about 0.5%. The mid-cap index is absolutely flat, and the bank Nifty is up just about 0.25%. So right now, this recovery in India is actually, slightly behind some of the other Asian screens as well. Anyway, let's talk about stocks. Ultratech Cement in pole position, recovery coming through over there, 3.5% higher. M&M on those absolutely phenomenal sales numbers, both on the passenger vehicle side, SUVs and farm equipment, 3.5% up on Mahindra & Mahindra. Aisha's sales very well received by the markets, about 2.5% higher over there. Then what do we have? We've got some buying on IT names like Infosys and Wipro, L&T, ICICI Bank, Bharti Airtel. These are some of the large cap heavyweights which are adding to the tally on the upside. Remember, there's very good Chinese manufacturing PMI data that's come out this morning. It's helping the likes of JSW Steel. So I don't know if it's spreading to the entire metals pack. Tata Steel is also tracking some gains for what it's worth right now. Hindalco is also higher. So metals not doing too bad either. The downside of the screen includes names like IndusInd Bank, down about 2%. Coal India is a little weak as well. And there's NTPC and ONGC, which is down. The biggest drag on the Nifty right now is Reliance. Reliance is sulking, down about 0.25%, at least for the time being. So that's how it is. Stabilizing, 100-point gain. The mid-cap at the index level, Nigel, is a little quiet.
Well, that's right. Post the clarification that's come in from Ultratech, these cables and wires players, they're heaving a sigh of relief. So I think Polycab was up. You have KEI as well, that was higher. And Havells as well. I think the first take of all these names was in the green. So some green on these stocks, though, they're just up or closer under % or thereabouts. Volumes have been falling, which is not good news for BSE. So after the fall that we saw last week, it's down another 2.5% in today's trading session. We're talking about, February being a very, very hot month, and things are only going to get hotter from here on. Voltas, that's up 2.5%. It's seen a sharp correction from the recent peak, but that stock is fighting back in today's trading session. From the broader markets, a couple of stocks, though, that are catching your eye. Welspun Corp, that's a big move is what we're seeing. The stock is up close to around 5%. So big up move is what we're seeing. Remember, these are some of the stocks that pulled back last week. But now, in fact, on very high volumes, I'm not sure whether there's any news flow, but that one as well is up close to around 5%. The other one is Credit Access. It was all over the place last week. I recall it surged more than 10% in a single trading session. On Friday, it went home with a cut of close to around 5% thereabouts. It ended at the low point of the day. So sharp pullback is what we're seeing. Coal India, well, the numbers actually were, for February, were a little bit underwhelming. So that's why that stock is down close to around 1.5%. Remember, it rallied in the last few sessions as well. But Ultratech Cement, as we pointed out earlier today, the street likes what they had to say on the con call. The core focus is going to be cement. This is a one-off diversification where they're looking at a higher wallet share of the customer. So that one is driving home the gains, up close to around 3% after the 8% correction we saw in the last two sessions.
So 120 points higher, 22,250 is where we are now trading at. Just a few other names. So Adani Power is up about 3% this morning, 493 on Adani Power. TVS Motor is up 4%. These are some of the big volume-led gains. Reddington is up about 3%. There is Welspun Corp, which is up 4% this morning. So coming up with volumes. Moil is up 3%. There is Wockhardt Pharma, which starts about 4% higher. I mean, steep fall, 1,600 type of levels, now about 1,200. Narayana Hrudayalaya, not seen too much price damage. That's up about 3.5%. I can go down the list, but volumes are completely disappearing. So they're not picked up, at least, beyond these 5-6 names that I've mentioned so far. And we've got IGIL. We have the company, the management joining us in a bit. So that's, I think, the Diamond Certification company. And that's the largest volume-led loser on the NSE. It's down 10% and it's got twice the amount of volume than as compared to the second largest volume-led cut. And the number 2 volume-led cut is Policy Bazaar, which is down 3% this morning. There is Patanjali, which is down 2.5%. Kim's is down 8.5%. That is at about 477. and Suvain Pharma. But again, volumes dry up pretty fast. Beyond the first 5-6 names, at least right now, volumes are looking a little low. So 130 points higher on the Nifty to begin this particular session. We have Karthik Kumar joining us, fund manager at Axis Mutual Fund. Karthik, good morning. Great to have you with us here on the program. Thank you for joining us. I think the simple question people want to know is, are we there yet? Even if the market does not recover quickly, is the bulk of the fall done? So let's start there, Karthik. What do you think?
If I were to hazard a guess, I would say we were probably there yet. We are probably there. But what's happened over the last couple of months is essentially, given the macro uncertainty, given policy uncertainty, and especially the transition in the US, essentially people and the market participants have questioned growth, which is why if you look at our own markets, growth stories have suffered the most. And especially growth stories where we've seen decent outperformance over the last year, or where, in other words, where momentum has been reasonably strong. That combination of stocks, or those baskets of stocks, have seen the most pain in relative terms. And in fact, what's kind of held up is are areas where there is deep value, or in other words, areas where there has been institutional interest has been not as high. Those areas have kind of held up well, and obviously large caps doing better than the breadth of the markets.
Okay, by the way, I'm trying to just find more positives here. A couple of other stocks on the auto radar that we've not discussed that are doing well. SML Isuzu's sales were very good as well, about 27% growth. That stock's flying away this morning, about 6% higher. Escort's Kubota, again, total sales were up about 11%. Some of the farm equipment makers have done well, 2% up on that. And of course, SML is up about 6% as well. So that's one pocket of green. By the way, the mid-cap index is already red. The bank nifty is already red. So it's really shaky ground that we seem to be on. Let's see. It's still early. That's the decline. But maybe this is one of those days where we have several waves after the kind of damage that we've seen in stock prices last week. Let's, get some more perspective. So then, Kumar, what is the sense? Let's talk about how to start buying in a market like this, where you don't know whether this is the bottom or if it's coming 1 week later or 10 days later or a month later. Apart from the obvious, and we've heard this, I think all our viewers know that I think there's a near consensus on buying large banks. Would you agree with that consensus? And beyond that, how do you start nibbling in a market where you don't know whether this is indeed the end of the tunnel?
I would agree to some extent on the banks being a bit more selective there, but I would agree there. But aside from that, one way to look at growth stories where growth is likely to be much more, there is much more growth visibility in the near term over the year or next couple of years. And if the valuations do get attractive with some of these growth stories, then I think they can be good entry points from a stock or a sector perspective.
So can you just name some of these pockets where now there is reasonable visibility on growth and valuations are also looking more sane? Some ideas?
So in terms of my own positioning, I continue to be overweight pharma and healthcare in general. I still continue to be overweight selective stories and consumer discretionary, while I continue to be underweight staples. And staples is largely a bottom-up decision rather than a top-down. And then commodities as well are sectors where I don't see much comfort there. So that's again an area where I continue to remain underweight.
All right. Hi, Karthik. Good morning and good to see you. And Karthik, this big debate about large versus small caps and mid caps. There was a lot of froth out there. Some of those stocks have pulled back a great deal. What would your allocation be right now, between the two?
Again, that comes down to the kind of schemes that we are managing. It will be different for different areas, but I largely agree with you that mid and large small caps have corrected. And in fact, even within the mid and large caps, mid and small caps, the correction has not differentiated much between whether you're looking at growth stocks or whether the stocks have growth visibility or not. So I think there are pockets that can be interesting there.
Right. Got it. Karthik, just a quick word on the IT services space, if you have a view. We saw very sharp falls last week, and it kind of caught up with the rest of the sectors. So it had fallen the least, but it's down. The index now, as of Friday's close, is up some 18% off its highs. What's the outlook there?
I'm on par or slightly higher than the markets in terms of the benchmark in terms of IT. Again, typically in markets like these where volatility is higher, rupee is kind of on the weaker side, IT tends to kind of hold up well over a reasonably longer span of period. So I'm hoping that that kind of trend comes back, and that the correction that we saw the other day was much more in keeping with what was happening globally rather than what is much more specific to our own sector.
Okay, all right. Karthik, on ground, the kind of feedback you're getting is with regard to, say, cement consumption. We had the core sector data that came in on Friday. And for January, it was up close to around 14%. We've seen in the past that maybe in the following month, it could swing by another percent. So maybe it'll be 13% or 15%. But cement demand has improved. And now you have the input costs that are cooling off as well. We know that the government, to hit their capital expenditure target, February as well as March will see the heavy lifting in terms of the capex spend. How do you approach something like that? Because that has nothing to do with regard to Trump, with regard to tariffs, with regard to China. It's a pure play on, the domestic India story. So your take, how would you play this theme?
So the way I would look at it is essentially the growth numbers sequentially have been good, and some of the indicators that you've pointed out have been quite strong as well. And given the expectations of an uptick in government spend as well, I would precisely look at areas where the stocks or the sectors have been beaten down, and as I said, where growth visibility continues to be strong. I think there are pockets in there which have gotten which have corrected disproportionately higher, slightly compared to where markets have fallen. I think that presents a good opportunity as well.
Okay. Kumar, in the beaten down areas, which were the erstwhile leaders of the rally, whether it's capex, defense, railways, industrials overall, do you find reasonable growth plus valuations, that combo anywhere in any of these sectors?
I think some of the selective names in capex do present you that opportunity. That's an area worth looking into. And otherwise, even within, let's say, selective stocks in pharma have corrected a bit, and that's something else that I'd look at.
All right, we'll leave it there. Karthik, thank you very much for joining us. Good conversation, and appreciate you sort of coming on here on CNBC-TV18. I think what we'll do is we'll just look at what the market is looking like for now, and then we'll get more stuff. I mean, IGIL is, by the way, as I mentioned earlier, and the management will be with us here in our studios in a bit, at about 366. Huge volumes. I mean, as I said, number one volume, and it doesn't come up on the leaderboard in terms of volumes, but this is coming off on very, very sharp volumes at this point in time. The high, by the way, after listing, and it's almost a 2025 listing, listed on the 20th of December 2024, and listed at what, 510, and ran up to about 650, and now close to about 350 now. So that's essentially what has happened here, and it's a sharp cut that we've seen. I guess we'll talk numbers on the outlook, etc. Now, what else, right? I mean, PB Fintech has picked up a little bit from the day's lowest point. So stocks at about 1,440. We've got Patanjali, which is down about 2.75%, 1,712. I mentioned Kim's earlier. Volumes are picking up a little bit now. Kim's is down 7%. Suvain is down 6.5%, 1136 on Suvain. Kirloskar Brothers is down 6.5%. Actually, last Wednesday, I think it was a Thursday, it saw a big up move, and then Friday sold off and it's down today as well. Naveen Fluorine is down about 3.5%. Mankind is down about 3% right now. Aarti Pharma is down about 4.5%. And a name like Craftsman on Friday saw a big move higher. Coimbatore-based Autoank is down about 4.6, 4.7% at this stage. So there is a fair bit happening. Market breadth, the NSE advanced decline will come up on your screen. It's completely flipped. 2:1 now. Declines outnumbering advances. So this is just 15 minutes into, not even 15 minutes into market open.
Just two things I wanted to highlight before we go to our next management conversation. One is the selling in financials. It's uncanny. And it's large cap, it's mid caps, it's everywhere. The Bank Nifty is down 0.4%. Look at the cut so early on in the morning on stocks like IndusInd Bank, Axis Bank. And if you thought it's just SBI, and it's not just the large cap banks, now you look at tier 2, IOB, Central Bank of India, UCO Bank, J&K Bank, RBL Bank. Now move to NBFCs, Manappuram, or other tier 2 banks like Ujjivan Small Finance Bank. I mean, it's across the board selling in financials, NBFCs, banks, large banks, big banks, small banks, PSU, private, across the board. And the second issue for the market is the selling that we're seeing in Reliance. This cannot be ignored, obviously. Reliance is suddenly down 2% early in the morning, looking a little tricky. And the mid-cap index now, Nigel, down almost 1%.
Well, that's right. Let's shift focus then to InfoEdge. That's the stock on our radar. The hiring trends and their outlook for 2025 is something we want to discuss. To help us out with that, we have Chintan Thakkar, the whole-time director and chief financial officer at InfoEdge, who joins us on the show. Hi, sir. Good morning and good to see you, Ben. What are the trends looking like? What's the activity you're seeing on ground? And tell us, how is the recruitment space shaping up?
So if you look at InfoEdge on an overall basis, and if you really look at it past 3 quarters, it has been inching up in terms of the billing growth that it has been showing. Last year, Q4 was about 7%, then it went to 11, then it's 14, 16. So I think it's gradual recovery, we are seeing it. And that's across the board. That's whether it's in recruitment business and similarly in non-recruitment business. Both seem to be kind of, there's a broad, growth, broad, story, in terms of the growth that, it has been showing. So when you kind of, cut the number and when you look at it from the geography standpoint, large customers, small customers, large developers, brokers, I think all businesses, we are looking at that it's a broader growth story and it's solid. So unless something externally significant happens, we would think that this quarter also should remain consistent to what we have been seeing it in the past.
Okay, all right. Let's get a number then out of you. Recruitment pre-COVID was at around 15%. Do you think for the next couple of years we can average mid-teens?
Well, past 2 quarters, it has been in mid-teens, and in fact, the non-tech sector has been kind of, in higher teens, and IT is gradually, inching up, So we are seeing the momentum, and we hope, and we internally, we feel that we should move to higher teens, particularly for recruitment business. And if non-recruitment business, which is in higher teens, if it grows into early 20s, I think that would be a good result for us for the quarter.
Okay, so you're looking at mid to high teens. Sorry, I missed that number. So I mean, at a sustained CAGR basis, FY25 to 25 to say 27, 28. You're saying you can do 15%, or will it be less than 15% growth?
I'm just saying for the quarter, if you look at the last 2 quarters, it has been in mid-teens, and we would hope that this quarter the momentum continues and we kind of inch up towards higher teens. It's very hard for us to really kind of predict about what will happen in next 2 years' time, because just like how volatile the stock markets are, the recruitment markets also keep on taking the clues from what's happening in the outside in the economy. And then accordingly, it keeps changing. So I think for the quarter, it seems that given that the past 2 quarters has been very consistent growth, and it's it's kind of a secular growth story. We think that this quarter also should remain consistent. We are seeing the building up in the IT hiring as well as in the non-IT hiring, and we think that should continue for some quarters to come in.
Chintan, on the IT hiring specifically, NASSCOM's numbers for FY25 did look very good. I mean, they're talking about hiring almost doubling from previous year's levels. And in our conversations, whenever we've spoken to large, IT players, including Mr. Salil Parekh, he's maintained that this AI disruption doesn't mean that less people will be hired. I mean, he was giving emphasis his own numbers. But the Naukri job speak index, I mean, I think the readings are a little more mixed. So on the IT hiring front, what are the immediate forecasts you have as we step into the new fiscal?
Well, particularly seeing from the lens of what's happening in AI, we think that jobs at the lower end, which are like customer support and the BPO type of jobs, may see an impact of AI and AI agents. Kind of there are many AI agents coming up, so you will see some impact over there. But I agree in general that AI is going to create different types of jobs with much higher productivity, and the same people can handle much more volume. So you will see the productivity gains, and that that in fact I would think that some of the internet and e-commerce companies have already started showing some productivity gains led by AI.
No, absolutely. Although the one common thing I've heard, Chintan, hi, morning, Prashant here, is that as everybody learns how to use these tools, right? And some of them are getting scarily good. And everybody is in the phase of learning how to use them. Companies are doing it. Eventually, it'll come to a point where clients, large companies who use IT services, Indian IT services companies are going to demand those cost savings, which essentially is going to then, the pressure will come then. Maybe it's not coming now. Do you agree with that, Chintan?
Well, I would say that the productivity gain could be there on both sides. On the cost side, we are definitely seeing that there's some productivity gain. And particularly if you look at, let's say, if you look at all internet and e-commerce companies, after people cost, the second biggest cost is the marketing cost, is the promotion cost. And we are seeing that the content creation is getting more efficient, is getting cheaper to create. The targeting of the audience is getting sharper and sharper. And as I said that you'll see a relatively, if not in absolute numbers, relatively the cost of marketing going down for some of those internet and e-commerce companies, and we have already started seeing some trend of that. So there will be a productivity gain on the cost side. At the same time, there will be many more opportunities of the productivity gain on the top line as well. Some of the new products that will come that will enhance the top line as well. At the same time, I think a time has come when India is going to build AI in India for India type of technology development that will happen, and you will see a gradual growth on the top line as well. So probably the tech companies will adopt some of the AI things much earlier than the other companies, and you will start seeing the benefit of that on the top line as well as on the cost structure.
We'll just get to real estate in just a bit, Chintan. You must have seen what happened with Technicolor, right? Technicolor India, very unfortunate. The headlines there, some 2,000 plus employees, and it's part of the Paris-based sort of group, and they worked on. They're not exactly IT, but they worked on visual effects, and I think they worked on The Lion King, and really pioneers. And one of the things that they're blaming is AI. Maybe it's a lazy excuse, and maybe they were not badly managed. I don't know. But it's starting to impact lots of areas, isn't it, Chintan?
I don't know particularly about what has happened in this particular case, but there will always be some news items that will say that, look, some people are being laid off. There will always be some good news about saying that more and more GCCs are coming in the country. Right? I was just talking to somebody in US last evening, and I understand Meta is, for example, is going to create a much larger center in India, and so there will always be this kind of churn will happen, whether it's in inter-companies or whether also in terms of what type of roles and what type of positions are getting created. As I said, the lower end will probably see a much more pressure, customer support and BPO type of industry. At the higher end, if you look at the machine learning and the data science guys and the people who are experts in AI, I think their demand is going through the roof, and you might see a kind of a wage hike much more in some of those segments in the days to come.
Okay, all right. Quick question, Mr. Thakkar, before we let you go. The primary market has slowed down a little bit. And because of that, some of these companies' valuations have seen a bit of a contraction. Any kind of write-backs or provisions you have had to make in some of those companies that you have invested in?
No, we really don't see a real pain in some of the startup investments that we have done. I think they are all fairly funded, and they seem to be showing a reasonable amount of growth. So we really don't see anything which is exceptional for us to call it out. If there is something, obviously we'll call it out. We prefer getting the bad news first in the market, but so far we have not really seen any pain in any of the companies.
To write down, mark down any of your investments to a large extent is what you're telling us.
Yeah, there is some small ups and downs that happens from quarter to quarter, and I think that we always do it, but I really don't see anything significantly changing.
Okay, all right. What about how's the real estate market? What kind of inputs have you got? Is there any kind of slowdown out there, negative wealth effect? Is it plaguing the industry, or is it as good as it was in the past? Because out there, the losses had come down drastically for 99 acres?
Yeah, I think the real estate market seems to be steady. Maybe in the luxury segment, there could be a little bit more pressure. We have seen many launches happening in the past few quarters, in the luxury segment. But at the mid segment, and probably that's kind of more relevant for us, I think market seems to be steady. The reduction in the cash burn that you are talking about is actually the efficiency that I just talked about, because of the marketing content is getting cheaper, and we are getting more and more efficient in how we kind of market ourselves. So you can see that the marketing cost relative to the growth in the top line is kind of coming down. And the same thing we are seeing in other businesses. For example, Jeevan Sathi, we are seeing a similar kind of a trend. And that's the efficiency that I have been talking about.
All right, we'll leave it there, Chintan. Great speaking with you. Thank you for your time.
Thank you.
Appreciate it very much here on CNBC-TV18. Well, 60 points, so there is a bid, and it's not... The problem for the last many days has been, well, buyers were absent, and hopefully buyers with some cash are there. And it's there. I mean, specific stocks, of course, are finding a bit of a bid, although I must say, market breadth in terms of broader markets, if anything, is only worsened. Three stocks down for every one which is higher at this point. So 22,000, just under 22,200 is where we stand. We come back and we get into conversation with... a stock which is under pressure this morning, which is IGIL, is limit down 10%. The management joins us from our studios. We'll ask them what's happening and what's the outlook going forward. Stay tuned.
Welcome back. Just a quick check on the markets before we carry on. And it is a downward drift on the Nifty. It's not looking good. After a 3% drubbing last week, I mean, the opening gains are quickly sort of settling down. And the mid-cap story, we've already told you. The mid-cap index is down 1%. Bank Nifty is weaker. Reliance is weaker. The other set of stocks to just look at very quickly would be wire and cables. Remember, Nigel was telling us when the market had opened out because of that Ultratech call, there was some relief that, okay, maybe all's not lost. But the thing is, the market's seen what happened with the paint sector. Companies say one thing and different kind of competitive dynamics can always play out in the market. So there's nothing cast in stone, so to speak, when a giant enters a new space. Though Ultratech is saying they're not going to be overtly aggressive. But anyway, for what it's worth, some of those gains have come off. Let's talk about one more stock that's under pressure today, and it's a recent listing. We're talking about the International Gemological Institute. They are, of course, into certification of diamonds, both natural diamonds and lab-grown diamonds. And we know that for IGI, their lab-grown business has really been growing because that's where the volumes are and that's how the market has been. Well, we have the management with us. So we have both Mr. Themsa Printer and Ishwar Iyer joining in. Gentlemen, thank you so much for being with us in the studios. Glad that you could make it. Obviously, the market's reeling under pressure and, there's maybe some sense of disappointment with earnings, and we'll get to that. But let's talk about the fact that the nature of your business is evolving because of the growth in lab-grown diamonds, right? Now, it's almost 60% of your business. Natural diamonds have come down to just about, I think, 20%. So it's important to understand what these changing dynamics mean for overall margins. This quarter, you've grown your margins to almost 57%. Yeah. But in general, do you earn lesser margin when you certify lab-grown diamonds versus naturals?
Okay, what happens is technically both are diamonds. Mm-hmm. One diamond is much more affordable than the natural one.
Sure.
Okay, so it's volume driven. Mm-hmm. So what is happening today is a lot more consumers are being able to afford diamonds, and diamond is an aspirational value for everyone. So we have gone into the fray by saying that we certify both diamonds, and we give you the origin, which is man-made or earth-mined.
Mr. Printer, we're aware of that. And I remember we had this conversation even at the time of the IPO, because this is going to be a big volume business for you. But we're just trying to understand, in terms of margin differential, where do these two categories stand?
So obviously, natural diamonds are unique and rare and in limited numbers. So our margins on natural diamonds is far more than the lab-grown diamonds, where, I mean, the price is also low and we have to keep our certification cost depending on the economies of scale that we get from volumes. So overall, the realization from lab-grown diamonds is less than natural.
And Ishwar, come in on this, because I think that's one concern which could be playing out in the market. Overall, of course, sentiment is quite weak in mid-caps. But that's the concern. You're at 57% margin now. Now, how much is that margin differential? And will volumes make up that entire differential? Can you sustain at 57% or grow the margin from here as lab-grown's share keeps on increasing?
Okay. So let me just give you an overall perspective in terms of how the business has delivered over the last 12 months. We've surpassed the 1,000 crore milestone as a company, which is a tremendous performance given where we started 3-4 years back. Revenue is growing 23% at the consolidated level. And just to touch upon that, we made a declaration in the RHP as well that IGI India would be purchasing the Belgium and Netherlands entity. We have completed the acquisition, and this is the first time, therefore, we are seeing the results at a consolidated level. So 17-18% on revenues. Overall, total income is up 20%. And again, my PAT growth is around 29%.
We have the numbers.
Margins, So the margins, etc., is at 57-56% is commendable given the nature of the industry that we are in. And just to touch upon what Temas mentioned, we have dynamics at play between natural diamonds as well as lab-grown diamonds. Lab-grown diamonds obviously compensate for the margin differential through the volume basis. So we are therefore 27-28% of volume growth also this year versus previous year. So that's the key driver for volume growth is driven by the lab-grown diamonds.
Is there a downside risk to your margin?
So there is, at the moment, we don't anticipate any downside risk because the volume growth should more than compensate for the slight differential between the two. Obviously, when we have a scale up of volume at the levels at which we are, we also have to ramp up our infrastructure in terms of basically adding more people, getting more space out there so that we are able to accommodate people sitting for grading, etc. But that is not very insignificant given the fact that our gross profit margin is around 80-85%. I don't think that should be a concern at all.
Mr. Printer, just a quick word on the need for certification itself. So this is from, again, it's a allied kind of transcript. This is Goldium International, which the company you know very well in the lab-grown space. On their conference call, right, somebody sort of pointed this out. And I'm going to just quickly read this out. He says, certification is driven by our customer requirements. As an example, in the US, when lab-grown diamond jewelry just started getting introduced, all customers, all large retailers required certification to separate the inventory, which was lab-grown, from the inventory, which was natural diamond. Today, with bulk of stalls in US crossing more than 50% of the inventory being lab-grown diamond jewelry, they find a lesser and lesser need for full certification or complete certification. That is it's a fundamental issue. I don't know if that is true or how do you see it?
But see, what is essential, and for lab growns, it is very essential to be authenticated by an independent certification body. Otherwise, it's just a piece of glass. So IGI provides that certification, that saying that this is a man-made diamond, and the other one is...
No, but what this seems to suggest is, because it was a new product, it was entering, and then you need to have that certification. But now if, say, 50-60% is lab-grown, then you don't need to certify everything. I mean, it is... the category itself is being replaced by lab-grown in some sense. So the need for certification perhaps goes down. That is what Goldium is suggesting. So just wanted your thoughts.
So what happens is, initially we used to certify smaller diamonds in lab-growns. Today, the average weight of the lab-grown diamond is increased to 1.5-2 carats plus. Earlier we used to certify 30 points. So what is happening is more and more larger diamonds of lab-growns, because they are also very affordable. So they are getting certified, and irrespective of whatever the price is, there is a awareness which is being created. Like if you see, 1.5% of the Earth's population used to buy diamonds, and that was all natural. today, because of the affordability of diamonds, this percentage over the next few years
will increase.
Will increase to 5, 8, 10%.
So are you saying at the lower end, maybe certification requirements may drop off gradually? But at the top end, the larger diamonds, certification will be required.
At the lower end, what will happen is that they will be included in jewelry. So there will be a big spurt of lab-grown jewelry, which we also certify. So just as we started initially with the loose stones, today we are also concentrating on the lab-grown jewelry, and we are taking that into cognizance.
Okay, all right. Hi, gentlemen. Good morning and good to see you all in. Let's get a couple of basic numbers out of the way. As you said, 1,000 crores for the year. And I think the growth you said in terms of volumes, the reports, I think, was around
27%.
What was the number?
9.3 million
reports, right?
Yeah.
What about in the upcoming year? What kind of a revenue growth are you guiding for after hitting that 1,000 crore mark, which obviously you all are quite pleased about? What's the revenue growth you're looking at? The margin picture, give and take everything with regard to the mix. And if you could quantify the volumes, please go ahead.
Okay, so again, there is a small portion of an industry analysis that we did during the IPO process. I think the way we're seeing this market is currently the gem and jewelry business is around $100 billion globally, expected to go to $140 billion over the next 5 years. The certification business in that component is around $600 million. Okay, and that is expected to go to around 1,100, 1,200. $600 million going up to $1.1, $1.2 billion over the next 5 years. The key aspect here is, the entire growth, over 20% of that growth, people are expecting it to come in from lab-grown diamonds. And just to the point that Tehmasp just mentioned, while we've been certifying stones, and which has been lab-grown stones, I'm talking about, that's seen acceptance in the US market in the last couple of years. But what we are now seeing, a trend that is emerging, is a lot of jewelry certification in lab-grown diamonds, which is happening in India. So we are looking at consumers actually starting to come into the fold as far as India is concerned. While the final stone gets into the jewelry, which is finally what people like you and me buy. That acceptance started in the US, but we are seeing a massive impetus coming in that aspect for the India business now. So that is going to be one of the key growth stories for us. And again, coming to the margin standpoint, I think extremely strong business performances, etc. We will obviously continue to deliver on managing the revenues as well as the cost in a way that the margins are protected.
Okay, no, but give us a couple of numbers then.
I think again, as I mentioned, overall, around
revenue growth should be what, 20%, 25%?
We should look at some volume growth in excess of 20%.
20% volume
between
growth.
12 to 15% growth on revenues.
9.3 should be around what, around 11 and a half?
It should be, you can add another 20% to that.
Yeah.
And you gave a revenue growth expectation, 15%.
We should look at between 15 and 20% CAGR over the next 5 years.
Okay, I just want to understand, because you gentlemen made a very interesting point in terms of larger lab-grown diamonds still having the need for proper certification. When you talk about your total lab-grown business, in terms of a volume breakup, how much would be large stones and how much would be the smaller stones or jewelry? What would be the rough mix right now? And I'll tell you why I'm asking this then.
Bulk of the volume is in 1.5, 2 carat plus.
Okay.
Bulk of it. Okay. And there are 10 carats, 5 carats, 20 carat stones also. Okay, but the bulk of it remains in this range.
In the large.
Yeah.
To come back to the point that Prashant also raised about the need for certification, whether it's jewelry or whether it's the smaller stones, could there be competition from jewelers themselves or manufacturers? It's like, because when you have an item which is priced at say 25,000, which could be a small piece of jewelry with lab-grown diamonds, you're competing with luxury scarves and luxury shoes and luxury bags. And a lot of those items do not need certification. It comes with the manufacturer's own certification that, yes, this is genuine leather, etc., etc. So just, going forward in the future, could that be a risk to the lower value part of the lab-grown business, which could be jewelry or the smaller stones?
See, where jewelry is concerned, I mean, it'll be a cluster jewelry. So there are a lot of small stones and it depends on the designs. Okay, but however, there has to be some branding. Even the luxury brands, they carry a brand value.
But it's their own intrinsic. Yeah. It's not a third-party certification, largely.
But, they have their own brand.
Sure.
Today, the jeweler as such need to authenticate that it is a lab-grown. So from that perspective, certification, independent certification is absolutely essential.
Okay. Got that, Mr. Printer, Ishwar, thank you very much. Both of you for joining us. Make diamonds great again.
Thank you.
I absolutely.
They're always great, lab grown or natural. As the woman on this panel, I can tell you that
absolutely.
diamonds will always sparkle.
You know, I'm still part of the 90.
We're very happy the moment that stone comes.
Of the 98%. Yeah. So when you said you and me, I was saying it's not me. not yet me.
Gentlemen, thank you very much.
Thank you so much.
Thank you very much.
Thank you.
And we'll chat again.
Thanks,
soon
Ed.
again.
Thank you.
I think we got what 60-point cut on the Nifty coming through 22,060. We have just a quick look at the market breadth, which is not improving at all. It's actually, if anything, it was 2:1 at the word go, 920 or so, 3:1. Now it's 4:1. 4 down for every 1 up. So this is like a slam dunk, at least for the broader market. So any hopes of recovery, etc., getting smashed and killed right at the word go. Although, you'll have to, of course, there will always be individual names here and there which are bucking the trend. So this morning it's Mahindra, which is up about 2%, Ultratech, which is up 2.5%, and Voltas, which is up about 2.6, 2.7% as well. And then you can sort of throw in a TVS Motor, Wipro, Eicher Motors, Natco. So lots of new names in the mix as well at this point in time. Elara Capital says that the failure of a bounce indicates a shift to a bear market verdict for the next 18 to 24 months. We don't like to hear that word, right? A bear. Now, to discuss this and more is in our charting trend segment. We have Biju Samuel, Executive Vice President, Quantitative and Alternative Strategy at Elara. Thank you very much, Biju, for joining us. Good morning, Prashant this side. So, put out the thesis, a bear market for 18 to 24 months, Biju. Is that the base case, according to you?
Yes, actually, we've shifted to this bear verdict since early January. And we were holding a structurally positive view on India since the COVID bottom. And the evidences started piling up, and most of them became really formidable by end of December, early Jan, to suggest that the market trend is really shifted to a long-term bear market.
Hi, Biju. Good morning and good to see you, Ben. So that 18 to 24 months, some months are already over, or are we at the start of that?
5 months. 5 months. There is no hard and fast rule.
But
right now, 5 months are over. What it shows is we've seen a durable peak. We are going to see a durable downtrend with multiple legs. So it can be, I would say, another, based on some of the patterns, at least another 3 quarters of negative movement. That's very much there.
What are the levels? Lower from here. So, price action wise, say the Nifty is down, I think, what, 16%, right? From the highs.
Yes.
The small cap index on the other extreme is down 25%. This is as of Friday's close. So, how much more here?
See, right now, the base case scenario is market testing the long-term support around slightly below 20,000. That is around 19,500. That's where some structural supports come into place. So my base case is the market testing that level, but obviously it's not going to go straight away there. My sense is we generally, the beginning of a bear market, the first leg always leads to a massive selling climax. So I think that generally happens when a prominent low is taken out, which I think could be the election low, which is 21,300. A move below that creates a bit of climactic sell-off, which leads to the end of the first swing in the bear market. Already the small caps index, mid cap index, I think they're below the election lows index levels. So maybe the Nifty could be following suit soon. Right now, 21,800, there could be a short-lived support, but 23,000 to 23,300 has become a big supply zone now, where a lot of people are waiting to exit.
Oh, Biju, so if I could just, recap this to map the numbers straight in our head, what you're saying that eventually you see supports emerging only around 19,500. And that intraday low on the election result day, I mean, that's nothing but a sentimental number. So you're not expecting 21,000 to hold at all, is it?
There could be temporary holding there, but as I mentioned, once a bear market trend is established, we are unlikely to see a sizable recovery till a full-scale selling climax is in place, where most of the hiding grounds, everything collapses in one wave. maybe a 2-3 days into that fall. So that's what I expect to happen when maybe that 21,300 is broken. So we may go to slightly below 21 in that swing. That could be the point for a bear market rally.
Okay, all right. Biju, actually, the headline index going to 20,000 or thereabouts, that's close to 10% away from here. The bigger fear is what happens to the broader markets. They are already down more than 20%. What happens to those indices, small and mid caps?
They would definitely be extending the decline. We cannot have a situation where the Nifty is going there and they are resilient, which is unlikely. Maybe we have seen the mid and small phase, and now the top stocks also joining in this phase. It could be something like that.
Okay, so Biju, so so globally also a top is in, you believe, in the US, etc.?
None of our frameworks are suggesting a bearish trend in the global markets, especially the DM bull market is still intact. There's a high probability that the US dip that we've seen last week, it's turning around. The Friday's price action seems to be more like a turnaround. Yes.
Got it. Biju, can it happen that the US stays, and there have been, you would agree, right? The last 3 years, 4 years, there's been very strong correlation between the Nifty and the NASDAQ.
Yes.
If you look at indices around the world, the NASDAQ keeps making newer highs and we keep plunging to newer lows. It can happen, like it's already happened for 4-5 months, but 18-24 months?
Yeah, so I think this is a specific macro break on India. In fact, we've been sharing this India's alpha break, those charts. Like if you look at Nifty relative to the emerging markets index, we broke an alpha uptrend after 4 years. We've been outperforming since early 2021. That structure is broken. So there is specifically an India macro negative here, and the US support here. I think the US market strength could help the IT in India.
Oh, okay. So just elaborate.
What is the specific macro break, Biju?
This is actually put it simply, if you take a relative chart of the Nifty, both the local Nifty as well as the USD Nifty, relative to MSCI EM index, I generally watch that relative with a 1-year average. It has been staying above that 1-year average since early 2021. And any setback in India's alpha was contained at the 1-year average. It was like a mean reversion. And since the last 1.5 months, we've decisively broken that 1-year average of India's relative. It actually puts us to a significant room on the downside in terms of further underperformance. We might underperform the EMs still significantly. I mean, the global market still significantly from here.
Okay, so the thing is now, Biju, going by everything that you're saying, we probably need to buckle up for another maybe 2,000 points down from here, if not more. So the question is, what could be relative safe havens? What could fall the most in this last leg? You mentioned IT. Now, last week, even IT didn't hold up at all because of maybe the NASDAQ was underperforming. But what should the strategy be from here on? Where should you take profits if you have any left? I mean, not many people would have profits. 1-year gains have been wiped out. But what could fall the most in this last leg? And what could be a relative safe haven?
Yeah, so IT is one place where I see, especially since middle of last year, the IT leadership has been sort of coming back. There is a potential long-term bullish structure for IT since 2020. I think the latest setback that we were seeing in IT the last few days, last 10 days, most likely it has reached the worst case within that bullish framework. So IT should be very attractive here. I think the US strength further should be helping it, especially when the US broader markets in the US, broader pockets in the US does well. Indian IT Nifty IT has done relatively well. So IT is definitely one. And the thing is, everything has the challenge also. The pattern is such that even IT should not stay weak till the end. I mean, where it is right now, it should not close there by the end of this month, where the quarter is ending. If the IT is closing weak or at these levels, or if the IT is not restoring from here, then there will be negative patterns there also. But I will not right now read into that. But I would look for restoration in IT. Pharma is also, I think, attractive. The main trend is strong for pharma. And these are the only two pockets, especially IT, where I find even absolute trends being positive, maybe for the next 16, 18 months. Otherwise, maybe on the downside, initially, the private banks are becoming a hiding ground, especially the last 10 days. So maybe that hiding ground may break. That's possible. I mean, its outperformance has reached a barrier. There is a chance of that weakening. Maybe the last few days of the selling climax could be characterized by a break in heavyweight banks.
Biju, 10 seconds, 10-second response to this. What would negate this view? Bear market view.
Yeah, ours is actually based a lot on a lot of multiple factors rather than a particular level. For example, first sign of strength for us would be when we see accumulation signs, the market rewarding those who are accumulating. Since the last 4 months, what we are seeing is any days when accumulation happened, the next day the market is falling. So at the same time, when there is distribution, the market is rewarding them. So this first sign that we look for is when there is accumulation days, the market gives positive returns immediately. Market showing a response to oversold. Now the market is stuck at oversold without any response. For example, on Friday, 35% of the stocks in Nifty 500 are below 30 in RSI. And after that, we are seeing a muted response.
Yeah. Biju, thank you very much. Those are sobering thoughts and sobering numbers, really, and something that we need to really take stock of. Thank you for joining in. As we're taking a break, the report from the screen is not good. India is underperforming in a sea of global green, where most markets have recovered, from Europe to Wall Street to Asia this morning. This is an outlier underperformance that has continued. The mid-cap damage has begun again so early in the morning. We're almost down 1.8% on the mid-cap index as well. So unfortunately, not much positive news to report from the street. We'll take a break, come back and look at some individual specific stocks. Welcome back. Let's put the spotlight on some individual stocks. PFC and REC are both in focus. We have Hormaz joining in. Hormaz, we're trying to find some newsmakers and maybe some green as well in the market. It's a tough morning. But anyway, tell us, why are you watching for these two?
Well, some positive commentary coming in and what has otherwise been an absolutely tough start to the new week as well. Both REC and PFC have been added by CLSA to their high conviction outperform list. But interestingly, both their price targets have been cut by CLSA to 525 rupees each. Now, for REC, it has been cut from 590 to 525, and from PFC, it has been cut to 540 to 525 from 540 earlier. For PFC, it believes that the existing pipeline of undisbursed loans will support double-digit growth going forward, and the ghosts of their past bad loans is almost behind them, and the outlook for future disbursals is positive for the company. Now, with the best delivery on loan growth, the return on assets, and dividend yields, and attractive valuations as well, it is what is prompting CLSA to add PFC to its list of high conviction outperform names. For REC as well, the commentary is relatively similar. Their undisbursed loans of around 55%, that is already signaling double-digit growth for the company. They have not had any slippages for nearly 3 years now, and the outlook on the new disbursals is also better, and they too have best-in-class delivery and a strong senior management track record. Interestingly, 12 analysts have coverage on both REC and PFC, and all 12 of them have a buy recommendation. For now, CLSA has added it to its high conviction outperform, a potential upside of up to 45%.
All right. Thank you very much for that, Hormuz, and we'll track what happens there as far as the REC PFC go. We'll take a quick commercial break here. We're going to come back, and on the other side, our special segment, it's the economy. Does the third quarter GDP hold good news? Lata in conversation with Sonal Verma of Nomura and Madhavi Arora of MK. Stay tuned. Conversation coming up.